The internet's version of this story begins with a wedding. Posts spreading across Reddit, and X said Leopold Aschenbrenner was getting married that weekend. At almost the same time, Wall Street was arranging a very different ceremony, the transfer of his public stock portfolio to Ken Griffin Citadel. Online, people called it a hit. The young AI Wunderkind is distracted. 3 giant banks squeeze his fund, and the veteran hedge fund billionaire walks away with the stocks after they crash. That is a fantastic movie. I don't think the evidence proves it. But the facts we do have are almost as dramatic. Situational awareness was under pressure after heavy losses. Bank of America, Goldman Sachs, and JPMorgan were reportedly helping it meet margin requirements or shrink positions. Citadel bought most of the broker finance public book. Axios reported that it bought all public equities. So keep one question in your head. Did Ken Griffin attack Leopold Aschenbrenner? Or did Leopold build a trade that handed Citadel the knife? Leopold Aschenbrenner did not come through a normal Wall Street training program. He worked on OpenAI's super alignment team, then published a 2024 essay arguing that AGI by 2027 was strikingly plausible. He built Situational Awareness LP around that conviction. For a while, he looked terrifyingly right. CNBC reported a 439% net return in the first half of 2026. Other reports put the fund around $20 billion. In my opinion, a run like that attracts worship. The returns start looking like proof that the manager sees the future. The accelerator was leverage, roughly $4 of market exposure for every dollar underneath the public book. Good calls look brilliant. Bad weeks arrive 4 times louder. Across the table was Ken Griffin, who founded Citadel in 1990. Leopold was selling a vision of the next decade. Griffin had spent decades surviving the next trading day. That experience gap matters because the fight was no longer about who understood AI. It was about who could still choose. Here is the play-by-play. CNBC said Goldman Sachs, JPMorgan, and Bank of America were helping the fund meet margin requirements or reduce positions. The banks were also reportedly marketing holdings on both sides of the book. Some coverage called these margin calls. Reuters said it was unclear whether literal margin calls happened before the Citadel deal. We know there was pressure and a sale. We do not know the words spoken on private calls. $10 explains the trap. Borrow $30, and you can hold $40 of stock. If it falls to $30, your cushion is gone. The broker can demand cash or start selling. That is where Leopold lost control. He may believe the stocks recover next month. His lenders do not have to finance that belief. They are protecting their money today. That is my first hard verdict. If your survival depends on your broker being patient, patience is not a risk control system. Put the reported wedding weekend beside those calls and you see why the rumor went viral. It is cinematic and still an unverified social claim. The pressure did not come from nowhere. On July 16th, Moonshot AI released Kimi K3, an open-weight Chinese model claiming near-frontier performance. Traders had watched DeepSeek hit chip stocks before. TSMC then reported net income up 77.4%. Its shares still fell about 7% with the chip sell-off. Great news could not rescue the trade. Then came Monday, July 27th. NASDAQ futures and chip stocks opened green. By 11 in the morning, the semiconductor ETF had swung from up 2.28% to down 3.3%, while the S&P 500 was basically flat. That does not identify an attacker. It does tell you somebody was desperate to get out of a very specific room. Tuesday, SKHY Nix fell 14.65% and Samsung fell 13 in one session. Wednesday marked the bottom for the Nasdaq tracker in our episode window. My read is that a real reassessment of AI spending collided with forced selling. The news lit the match, leverage poured fuel across the floor, and then the terminal headline arrived. Bloomberg's July 30th headline said it plainly. Citadel snaps up AI stocks from situational awareness amid rout. The Wall Street Journal reported that situational awareness sold the bulk of its stock portfolio to Ken Griffin's investment firm after deep losses. Axios went further and reported all public equities. Large portfolios get shown to potential buyers, and Millennium also reportedly bid. Citadel won and bought most of the leveraged portion, while situational awareness kept private investments, including Anthropic. Then the screen went green. Microsoft rose almost 14%, Micron rose 15.6%, AMD rose 13%, the semiconductor ETF jumped 8.5% in one day. You can see why the internet lost its mind. The stocks collapse, Leopold gets pressured, Ken Griffin buys, and the same names rip higher. It looks like a Wall Street heist movie. But sequence is not proof of intent. A rebound after a forced seller leaves is exactly what you might expect, even if the buyer caused nothing. My verdict here is simple. Citadel did not rescue Leopold. Citadel negotiated with a seller who had fewer choices. That is not charity, that is leverage changing hands. Give the internet's theory its best shot. Reddit users argued that Citadel or Citadel Securities talked the market down, pushed Leopold toward liquidation, then bought at a discount. Your screenshots capture that allegation. To be fair, the optics are outrageous. Ken Griffin founded both firms, and Citadel Securities had published a hawkish Fed view. If you distrust Wall Street, the story writes itself. But Citadel and Citadel Securities are separate firms, and that Fed view appeared weeks before the purchase. Millennium also reportedly bid. The public evidence does not prove an attack. Here is my take on the whole thing. Calling this a Citadel attack gives Ken Griffin too much credit and Leopold too little responsibility. Citadel did not need a secret plan. It needed cash, information about a motivated seller, and the ability to wait. Situational awareness supplied the urgency. I know some of you will still call it a setup, so tell me below, setup, opportunism, or both. I will read the strongest argument on each side. My current vote is opportunism. Ruthless? Absolutely. Proven manipulation? No. Now for the line Leopold's defenders are right about. He did own hedges. His March 31st SEC filing listed large put positions against a semiconductor ETF and names including Nvidia, AMD, Broadcom, Micron, and TSMC. So saying he never hedged would be false, but stopping there would miss the entire lesson. A put can pay when a stock falls. It does not cap leverage across the book or force Goldman Sachs, JPMorgan, and Bank of America to keep lending on yesterday's terms. Leopold hedged positions. He did not hedge the path. He did not protect the one thing that mattered when the market turned, his ability to decide when to sell. That is the risk management failure. A reported 439% return hit a fragile structure. With 4-to-1 leverage, the applause gets loud right before the floor disappears. He may have been directionally right about AI. He was not financed to be early, wrong, or unlucky for very long. In markets, that difference can eat the whole public book. The reports describe different numbers. Up to 45 billion at peak, around 20 billion in assets, and about $16 billion in public equities. Citadel bought most, or by Axios's account all, of that public book, not a proven $45 billion portfolio. Situational awareness was not erased. It reportedly retained private investments, including Anthropic. Leopold can still be right about the destination. He lost the public market vehicle on the way there. Ken Griffin's advantage was patience. Citadel could wait for its price. Leopold could not wait for the thesis to recover. Once the buyer controls the clock, the negotiation is over. I cannot prove Citadel attacked him during wedding week. The more embarrassing conclusion is that it did not need to. Leopold's leverage and financing terms did the damage before Ken Griffin signed. That is my rule coming out of this. If somebody else can choose when you sell, you are not fully managing the risk. You are renting time. This is educational commentary, not financial or investment advice. Our certainty labels stay on screen. The internet called it an attack. I call it a risk management failure that Citadel was perfectly built to exploit. Which explanation fits the evidence better, and what would change your mind?